everyone, welcome to At Home with Hayley. We are in February. How did that happen? Although I've got to admit, January has been a very long month and I'm quite happy to see February. So while everyone's coming through, I can see that people are dialing in. Can you just pop in the chat box that you can hear me loud and clear before we jump in today's episode? We have a wonderful guest for you today. Many of you may know him, so I'll introduce him shortly. For those that are new to this webinar, this is At Home with Hayley. I am, of course, Hayley Andrews. We are a free webinar series that happens on the first Friday of every month, 9 o'clock UK time, and we talk all things property. We have guests that come in and talk about their area of expertise. It's educational, informational, and fun, hopefully. I think we're nearly 3 years in now. So we started off as a lockdown kind of information webinar just for our internationals, because we are worldwide across 18 different countries. To have an update on the UK property market. However, it's been extremely successful, and we have excellent feedback, so we are still running it to this day. So I can see that people are saying that they can hear me. Good morning. Let us know what countries you're calling in from. I can see that we've got Sweden. We've got a few Swedens, actually, Hong Kong, Singapore. So let us know where you're dialing in from. That'd be fantastic. And we'll jump over to today's guest. So our special guest today, you all may not know him, but many of you may have known him through training with Your Freedom Empire, or through the other YouTube videos that we have done in the past. So we have our wonderful resident mortgage broker, Mr. David Eva of the Mortgage Organisation. David, are you there? Good morning.
Good morning.
That was an introduction, wasn't it?
Stellar.
I did that on no sleep for 2 days as well. My son is ill at the moment, so I was just saying to David before we went live that my eyes are really closed and I've painted them on. So hopefully I can manage to get through this next hour. But I'm going to hand over to you. So you've got the hard work, haven't you, David? So while I'm actually loading the slides, just for those that don't know who David Eva is, do you want to give a very quick, short introduction, and I'll grab your slides up for you?
Sure. So my name is David Eva. I'm the managing director of a firm called the Mortgage Organisation. I've been a broker in the industry since 2003, and the Mortgage Organisation has been in operation since 2006. So we've seen the ups, the downs, the good times, the bad times. I'm not quite what we define at the moment, but the unusual times. So hopefully by the end of this presentation, you'll be able to see where the UK market is sitting and what we think the outlook for interest rates is going forward.
Brilliant. I'm going to hand over to you. After your slot, we'll take some question and answers. And so for those that have questions, pop them in the chat box. We will have a section after David's to go through any questions that you may have. And then after that question and answers, I will be going through a market update for the UK property market as well. So David, I'm going to hand over to you.
Thank you, Hayley. So welcome everybody to the UK market update for February 2023. On the screen now, the topics that we're going to discuss today. So I'd like to give you a quick update of what happened yesterday with the Bank of England and their decision to raise interest rates. We'll also discuss about how mortgage pricing works, so investors can actually see what the market is predicting for the future. We'll also discuss how banks are calculating what they lend to people. So this is really important information for investors. You can actually try and understand what lending's out there and how much lending you can get. Then we'll touch on some key dates that's coming up that you need to place in your diary. And because we've got higher interest rates now, I've put together some slides to show you some alternative strategies. Because with higher interest rates, we're going to need higher yields. So what type of strategies are out there to help investors reach that objective? And then finally, I'll show you the current rates for bridging and for all other regular mortgages, including those for international investors. So let's jump in, shall we? So for those of you who are unaware, the Bank of England is responsible for price stability in the UK. The target set by government is 2%. And as you can see on the screen now, the inflation number is way above target. One of the tools the bank can use to try and tackle inflation is to raise the base rate. And yesterday, the Bank of England raised the terminal rate by 0.5% to 4 percentage points. Now, this is their 10th increase in a row. And yes, you did hear that right, 10 interest rate rises in a row. It's therefore imperative for investors to understand what the bank is thinking as they shape the interest rate landscape, which in turn affects investors and their strategies. As I mentioned just now, this is their 10th rise in a row and is illustrated on the screen now. This next chart is a really good illustration of how far we have come in the past year or so. For those on variable rate mortgages, they must surely be feeling the pinch now. However, the governor did indicate that this rate rising cycle could be coming to a close soon. This next chart shows how average fixed rates have peaked around the Liz Truss and quasi-Kwarteng government. So that was around September last year. And now we can see the rates are slowly coming down. This is great news for investors, as it does indicate the market thinks medium to long-term interest rates are beginning to fall. So let's dig into why the Bank of England has taken the decision to raise rates yet again. Put simply, it's more or less down to inflation. The Bank of England governor said in his press conference yesterday, since the last meeting in November, we've seen the first signs that inflation has turned a corner. The annual consumer price index is down from 11.1 in October to 10.4 in December. Now, as high as this sounds, this is still lower than what the bank forecasted in November. If you look on the screen now, you'll see two charts. The one on the left-hand side is the forecast that they made in November, and the one on the right-hand side is the forecast the bank made in the most recent one in February. So as you can see on the right-hand side, you can see inflation is coming down and is predicted to fall in the middle of the year and then fall sharper later in the year. So why is inflation forecasted to fall? Well, this has a lot to do with energy prices, as last year's annual increases are beginning to fall out of the calculations for the Consumer Prices Index. Also, wholesale gas prices have fallen 50% since November, and gas future prices has reduced significantly as well. So the Bank of England governor also made reference to falling input costs as supply chains are reopening globally as well. So if all goes well, inflation should start to fall, and this should be good news for interest rates and therefore good news for investors. So on the screen now is the chart the Bank of England produced yesterday with regards to their future predictions for interest rates. Now, the governor could not have been clearer in his press conference yesterday when giving forward guidance. He said rates are expected to rise further from current levels, but the market implied level of policy rates is now lower at the 3-year horizon than in November. So in the UK, the market implied path for rates now peaks at 4.5% in the middle of this year. Now, he explicitly used the number 4.5%. So investors should take careful note of this language, as there was no ambiguity in his statement. Absolutely none. For those regular market watchers, you will know that central bankers rarely state specific numbers and trying to use language which implies what they are planning to do rather than stating an actual figure. This was my biggest takeaway from the press conference yesterday, because you just rarely see this happening. So 4.5% is probably where the interest rate will peak. So where do we go from there? So swap rates. So the swap rates are a really good indicator of what the mortgage market is thinking about for the future. So to give you just a brief description of what they are, swap rates are when two parties swap interest rates payments for another. So one party agrees to receive fixed rate payment while the other receives a variable rate payment. So in the case of mortgages, this is what lenders pay to financial institutions to acquire fixed funding for a set period of time. And this is why cost of swap rates is used to price mortgage products for lenders. So as swap rates are based on what the market thinks about interest rates will be, if they rise, the mortgage lenders will increase their pricing to maintain their profit margin. Thankfully, the markets have calmed in the past few months, and we're seeing 1 or 2 basis point changes per day in swap rates. As you can see from the chart on the screen, the swap market is predicting a drop in rates over the next 2 to 5 years. But I think it's safe to say the era of ultra low rates have come to an end, so investors need to adjust their strategies accordingly. For those of you who've not heard of this benchmark, Sonia, it stands for the Sterling Overnight Index Average and replaced LIBOR last year. I think this chart really does illustrate how the market thinks that over the next 2 to 5 years, we're coming to the peak of this interest rate cycle. Because if not, why are swap rates, for instance, at 3.58 for a 5-year fixed? Okay, so now talking about interest rate coverage. So when a bank is assessing a loan, especially for buy-to-let mortgages anyway, the bank's more or less concerned about how much rental income the property can generate. So if the interest rate on a product has changed, that will affect the monthly payment on the mortgage. So what we're seeing now is that the stress test, so the ICR test, is much harder to beat, because the banks have raised the threshold for what the test, or how the test is applied. So if you look on the left-hand side of the screen there, that is a matrix from one of the biggest lenders we have in the UK, part of the Lloyds Banking Group. So their stress rate for all their products, if we look at the top slide, so if it's over 60%, so all of their products over 60%, the stress test is 6.5%, or the pay rate plus 2%. So at the moment, I think their mortgage rates are around about 5%. So that would mean the stress test would be 7%, and then plus whether you're a higher rate taxpayer or a lower rate taxpayer. So that would then go up by either 25% or 45%. So as you can see here now, the stress tests that the banks are applying are getting harder and harder to beat. So what happens in this scenario then is you either have to put down a bigger deposit, which I know most investors don't want to do, or look for a higher yielding investment. So I've also given another example of another lender we work with, Skipton Building Society, and their stress test is more or less just as harsh. But if you take a 5-year fixed mortgage, they'll offer you a 6% stress test at 125%. So a little bit better than the other option there. Now, one other way of trying to beat the stress test is to use a limited company. A limited company mortgage is always stressed at 125%. And we do actually have some lenders who don't use notional rates. They actually use the interest rate that's applicable on the mortgage and apply the test from there. So that should really help investors boost their borrowing power because the stress test will be on a much lower basis. So here's another example of another lender that's big in the UK, Nationwide Building Society. They're raised their stress rates as well. Not as bad as actually as Lloyds Bank, but it's still, we're still looking at pay rate plus 2% there, higher of pay rate plus 1.5%, and then it's stressed further again. And if it's an HMO, 170% there. So it's becoming more and more difficult to get big loans or bigger loans, say at 75%, because the interest rate environment is causing lenders to assess their calculations of what they lend, so they're not lending people too much. So what I've done for everyone here is I've done some calculations and shown you how much you could borrow in certain scenarios. If we just take them one by one, in the first column we've got a mortgage that was taken out on an individual basis. And the property price is 150 and the loan is 75% of that. Now, because the interest rate is a 2-year fixed of 4.09, I've had to increase it by 2% so I could get a notional rate. And then after that, the interest rate needs to increase, or sorry, the stress rate needs to increase by 25%. So in the final box there, or the final box, we have £713 a month would be the minimum rental income required. So I've repeated that process all the way down. So for the different scenarios, so if we're applying a stress rate at 145%, then it comes out 827, and so on. So this just illustrates really how, if we can put a property in a limited company, those two final columns, and we take a 5-year fix, and that's really important because that's the pay rate of the mortgage and not a notional rate, we can bolster our borrowing power, and we need a lower rental income for the application to actually pass. So it's certainly worth considering for many reasons, actually, limited company mortgages, but this is one of the most important reasons, I think, especially right now in this higher interest rate environment. We're going to get bigger loans if properties are put into limited companies. Right, so some key dates that investors need to be looking out for. So the CPI data comes out on the 15th of Feb and the 22nd of March. As we were discussing earlier, inflation is the biggest indicator right now of where interest rates are going. So if it does continue to fall, which it is being predicted and is falling, then that's great news for us as investors. And then we should hopefully see interest rates coming down. GDP data is another important metric, because if the economy does keep slowing, then the bank will struggle to provide a rationale really to keep raising rates. It's going to be very dangerous for them if they keep raising when we're going into a recession, for instance. So if the GDP numbers come out not so good, then that's going to be good news for us. So bad news in this instance is probably going to be good news. But the GDP comes out on the 10th of Feb and then the 10th of March this year. Yeah, and then the next all-important Bank of England meeting is on the 23rd of March. Let's hope they don't raise rates again. They have said perhaps in the middle of the year they may peak. So, is it going to be next when they go up? It's really too early to say, but hopefully not. But there's the date in your diary for when the meeting is. Right, so what strategies should investors be looking at if we're in a higher interest rate environment? So the most obvious answer is we need to find higher yielding investments. So things like multi-unit freehold blocks, so that's multiple units on one freehold title. So you can even have a situation where it's one property split into two. That would be classed as a multi-unit freehold block, but then you can extrapolate that out. You can even have up to 8, 15 units on one title. That's called a multi-unit freehold block, but we don't want any commercial elements within that that property. It must be purely residential to get residential rates. HMOs is another good strategy at the moment, with a slight caveat about the energy costs, because as an HMO landlord, you are responsible for all of the costs. So you do need to be thinking about your energy costs and how you can maybe cap those with tenants. But HMOs are a great way of generating more income from a property because you'll have multiple rental income streams coming in rather than just the one tenant. And then another high yielding strategy potentially is holiday lets. So that's also known as serviced accommodation, where tenants can rent rooms or they can rent the whole property on a short-term basis. They're not meant to be on a long-term basis. It's literally for people to use them while they're going on holiday or for a business reason, maybe perhaps. So it's just a short-term tenancy, maybe 1, 2 weeks, maybe even a month, no longer than that really, to get one of those type of mortgages. Right, so I'd also say to everybody, don't panic right now. Just make sure if you do have existing mortgages, you know precisely when your fixed rates are ending. A lot of the lenders are now offering new products within with 6 months remaining on your current product. So make sure you've got all of that information stored. Do a little spreadsheet, I suggest, so you know precisely when your fixed rates are ending, so you can think and plan way ahead as to what you're going to do when the fixed rate ends. Because if you're used to ultra low rates, you're going to have a very nasty surprise when that fixed rate ends, because the standard rates banks are charging have gone up significantly. So you need to be planning for this because it is going to happen. So don't dig your head in the sand and be ready for when that time comes. Right, and the final point on the strategy section there is about consider taking trackers. So at first I wasn't that keen on this strategy, but I think where we are right now in the cycle, and if you think, as do I do, that the rates are going to drop, then it may be a good idea potentially to, depending on your circumstances, to consider taking a variable rate tracker mortgage. Because if the market is going to peak, you don't necessarily want to be on the wrong side of the, when rates come down, because you're going to be locked into a fixed rate when the trackers are actually coming down. So in certain circumstances, it may be more sensible to actually take a tracker than taking a fixed rate right now. Right, so on the screen now are the current rates we have available for a multi-unit freehold block. So there's various options here. So you'll see there is a discounted variable product available. So these products are slightly different to a tracker mortgage, because when the product is defined as a discounted variable product, it means that it's discounted from the lender's variable rate. So it's not directly correlated to the Bank of England base rate, although there is some correlation, because as the cost of borrowing goes up, then lenders tend to increase their standard rates. But you shouldn't confuse a discounted variable with a base rate tracker, because there's no automatic change in the rate when the Bank of England do raise the rate. However, with this lender, you can actually have a product. So if you take the top line product, there's the second row. There's a product with no early redemption charges. So if it does get a little bit too hairy, you could potentially refinance away and take a fixed rate somewhere else. So you're building the added protection if you take a variable rate mortgage with no early repayment charges. However, there is an additional charge here of 1% on the fee to take the no early repayment option. So it's a nice spread there. So you've got between 5.39 and 5.59 for the fixed rates. Not too bad, I think, really. So it will depend on the rental income. So if we need to stretch that rental stress test, then we may be forced to take the 5-year fixed. So that's why I was saying earlier on, it depends on your circumstances, whether the variable is going to be better or not. But the minimum loan for this company is actually 75,000. So that opens up many different doors, I think, for the multi-unit freehold plots, because you can look all over the country for those, because really you just need to find one that's over 100,000, and then you can qualify for a loan with this company. They do first-time landlords as well, which is quite handy as well if you're just starting out. So that's something worth noting. And these rates also apply to limited company loans if it's a regular buy-to-let. But right now, I think the better strategy has got to be looking for multiple income streams from your asset. Okay, bridging finance. So sorry, the rates are a bit small on the screen there, but that was all I could really do when I was cutting it from the product matrix. But interestingly, this lender will actually lend 85% on a bridging loan. So that could be quite handy for some investors. So I don't know if you can see on the screen there, but maybe you can zoom in on YouTube. But they will lend between 75 to 85% for the refurbishment costs only. Okay, so up to 100% of the refurbishment costs can be funded, but the total loan amount cannot exceed 85% of the day one purchase price. Or 65% of the post value works, whichever is lower. So it's really handy, that, I think, because that's quite an innovative product at the moment, especially having 85%. Because one of the problems you do have with bridging finance is the majority of lenders will deduct the interest and charges from the loan amount. So with this lender, if the affordability is met, we may not need to deduct the charges. So we might end up with a net 75% on day one. So at the moment, if we went for the 85% product, it'd be 0.95 per month. And at 75%, it's 0.78% per month. And at 65%, it's 0.68% per month. So there's the rates aren't too bad actually when you look at the where the sort of wider market is. So if you think these are good, please get in touch and we can send you a quote on these. There's also the ability to do residential to commercial to residential as well. With this lender, the rates are a bit higher. So and also you need a bigger deposit, but that's 0.93 for a commercial to residential type of product. Right, service accommodation, holiday let mortgages. So just a quick definition for you. So the lenders will define service accommodation mortgage as short-term let, so no more than 30 days. There cannot be ASTs. They don't want lenders, tenancy agreements that are longer than 30 days. You can't have people in there for 6 months. That's not going to be permitted. They need to be in holiday let areas. So those type of areas are coastal, rural, and city centres. Those are the ones that lenders are really looking for. And nowadays, it's much easier to finance these type of mortgages from the get-go, because rather than using the occupancy data that you have, we can ask a holiday let agent what their opinion is of the rent in medium, low, and the high seasons, and the banks will use that as the proof of the income the property can generate. It's going to be much easier for you to apply for a holiday let mortgage when you buy the property. Okay, and the other major benefit of buying a holiday let mortgage is you can actually use the property as well, if you would like. I mean, obviously, if you're using it, you can't rent it out, so you just want to do it now and again. So you can, make the most of it. But, if the property's empty, why don't you just use it? The rule is that it must be on the market for 210 days per year. You've got all those other days in the year, 150 days that you could potentially use it and still be within the rules. You need to have the property occupied for 105 of those 210 days. So all in all, it's worthwhile considering this strategy, I think. And on the screen there, you'll see the current rate for this type of mortgage, 4.69, which, all things, thinking about everything that's going on right now, I don't think that's too bad. Right, so what I did last night was I ran some sourcing results through my mortgage software system to give investors a flavour of where interest rates are sitting at the moment. So the next few slides are going to be the same case but for different products. So it's 100,000 purchase price, loan amount 75,000, client earning 25,000. These are the type of rates that we're seeing right now. So TSB came top of the pile when you considered all of the costs, but we're still 5.84 for a 2-year fixed mortgage right now. And here we are for a 5-year. So the 5-year is actually lower than the 2-year. So it kind of feeds into that narrative that the Bank of England are saying, where we think rates are going up and then they're going to come down again. And that reflects in this pricing here, because ordinarily, for the last 10 years or so, we would expect to see the 5-year fix at a higher price than a 2-year fix. But now we're seeing the reverse. Now we're seeing the 5-year fix are more expensive than the 2-year fix. And that would feed into, we think rates are up and then down. So here are the variable rate, no early redemption charge mortgages at the moment. So these are actually cheaper than both the two options we just shown you there. So at the top there was Cambridge Building Society at 4.34. Yeah, so just so I should explain this at the start, but when we're running these searches, we're actually calculating the total cost. So there's a column there for total to pay. So this includes valuations, arrangement fees, all the costs basically. So we know who is the cheapest, taking into account all of the cashbacks, fees, things like that. So 4.34 for a no early redemption charge mortgage is what the market's charging right now. And then another strategy potentially, if you think rates are going to go up and down, is to not tie yourself in for longer than a year. So how about considering a 1-year fixed mortgage? So at the moment, a 1-year fixed mortgage now, 4.14, the mortgage works. That's Nationwide Building Society with a fee of £1,500. So just, there's various different ways you can go with it, and it's a topic of discussion you should have with a financial advisor or a broker to work out what works best for you. And get all the options actually. Why not get them all and just look at them and then, get the illustrations for all the options and then, have a discussion with your broker about it. Okay, right. So here are the current rates we have available at the moment for international investors. So they have gone up in recent months, unfortunately. So if we take lender one, for instance, their rate at the moment is now 7.79%. They have also increased their arrangement fee to now 3%. It was at 2%. And I think this is a common thing we're seeing around the marketplace at the moment, where in order for banks to try and keep the price on the pay rate down as much as they can, they're front loading mortgage products. So don't be surprised if you see higher fees on the mortgage products that are being offered. But remember, you need to account for all of the costs. So make sure when you do your calculations, you're thinking about interest rate and the fee. Because I've seen some products out there where they're even charging 5% for a mortgage, which was pretty much unheard of last year. But the banks are now, especially on the buy-to-let side, we're seeing more and more front loading of products. I don't know if it's opportunistic of the banks. I don't think it is actually. I think it's more, as I said just earlier, a way for them to, for them to make a profit, but keep the pay rates down on the mortgages, because that's really what affects what they can lend to people, because the monthly payment has to be affordable. And if it's not, people are going to fall into arrears. So by front loading the mortgage, they can keep the rate down, and the bank can still make the money it wants to. So lender 2 might be of interest if you're looking for a smaller property. So their minimum loan is 50,000. So that their current rate is 7.77. However, you can defer part of the interest. So we can defer 1.5% per annum on that. So what happens there is that the pay rate will, so you pay, the rate you pay every month will be 6.07. No, 6 point, sorry, there's my maths. It's too early in the morning. 6.27 on a monthly basis. And then they'll defer 1.5% per year of the mortgage. So it's another way of helping the investor acquire the property, but also keep those monthly payments down so you don't fall into arrears. Lender 3 there, we tend to use them for first-time buyers. So if people have never bought a property before, they're available. And you've also got this added benefit of no early repayment charges. So you can go into this, you can take a fixed rate and have no early redemption charges. So that could be really useful for you, where if interest rates do start to drop, you can redeem this mortgage without a penalty and still have a fixed rate. So it's really quite a unique product actually, and hardly any banks offer a fixed rate with no early repayment charges. The general rule of thumb is that if you have a fixed rate mortgage, there are going to be penalties. Right, and then the final lender we've got here for international investors at the moment is only available to individuals, no limited companies. But the personal income of the applicant must be 50,000 or above. So these are where we're seeing the best rates. So they're anything between 4.69 and 5.19%. But you must buy in a personal name. But their stress test isn't so bad actually. So the stress test is based on 25%, 125 of the pay rate. So we don't need to worry too much about that, because it would be the same as what it would be for a limited company elsewhere. So if you're comfortable putting a property in your personal name, then why not consider lender 4? But you must be on 50,000, and they only lend on buy-to-lets. It's not going to be HMOs and multi-unit freeholds, unfortunately. Okay, so just finishing off now. So how can we help you, the investor? So we work for you. We do not work for the lender, although we do have a duty of care to the lender. Ultimately, we are representing the investor. And we've got access to software which we update every day, which tells us what products are out there for each individual customer. And by doing this, we know the lender's criteria very well, because we're dealing with them on a daily basis. So my role will be really to be a matchmaker. I won't take you to a bank which I know is not, or is unlikely to take your case. So by working with them, you get to feel what they like, what they don't like. And another way we can help you is that we offer a free review service. So if you set up a mortgage with us, and we've got a mortgage in place for 30 years, we will review that mortgage free of charge every time the product rate ends. And there's no additional charge to the investor for the entire duration of that loan, be it 5 years, be it 30 years. Okay, so that's it from me. So if there's any questions, please fire away.
Fantastic, brilliant. Thanks, David. That's a very, very good service. No additional kind of fees a review. Fantastic, brilliant.
Yeah.
Right, okay, so we do have some questions. I'm going to go in order. We have a question from Stephen. So he's asking, what does the 125% stress rate mean?
Yeah, so the rental income of the property needs to be 25% above the mortgage payment. That's what it means. So you need to do a calculation to work out what that mortgage payment is going to be. But not all banks actually use the mortgage payment rate that you're using. So that's why I was showing you earlier on. If you take a 2-year fixed rate, it's quite often that the bank will increase it by 2%. Then they'll lift it by 25%, and that's how they work out what the stress test is. So to get the maximum loans, you generally find you have to take a 5-year fixed mortgage with a limited company, because the stress rating is lower for the limited company and on the 5-year fixed.
Yeah. Brilliant. Hopefully that answers your question, Stephen. If you do have any more, pop them in the chat box. So actually we have another question from Stephen and I'm going in order here. So the next question is, can you mortgage limited company portfolio for properties for personal home buy?
Sadly not, no. When you sign up for a limited company buy-to-let mortgage, you will agree not to occupy it, and you will agree to not let the property to a close family member. So it is going to be restrictive, unfortunately. Really, when you take out a limited company mortgage, it must only be let to tenants that are pre-agreed, really, with the criteria of the bank. So everybody has their own criteria with regards to who they allow to occupy the property. You don't need to keep getting their permission all the time, but there are going to be criteria such as it can't be a vulnerable tenant, anyone deemed to be vulnerable, and really you want a tenancy agreement direct with the actual tenant. So subletting to a housing association or a third party is generally not accepted.
Yeah, we see it happen quite a lot, don't we, with questions that come to me as, of course, a training organisation and a mentor, and of course, then come on to you as well, David. So we get lots of people that assume if they have a certain mortgage that they can do whatever they want with that property, but there are restrictions around how that property is occupied and who occupies that property as well. So it's very, very important to understand your mortgage terms and conditions and not just to assume that you can run that however you choose as the mortgage is approved, because there are, as you said, restrictions around that. We see it a lot with serviced accommodation as well, David. I'm guessing you do as well. Yeah, so it's always better to make sure that you have the right mortgage product for how you're intending to use that asset, and never to guess.
Yeah, I think that's right. And also, I mean, there are ways to deal with it. I mean, if you do want to let to a housing association or a, I don't know, a charity who shelters people, you know, we have got some products where we can do it, but we need to know what your strategy is, because then we can take you to the right lender. So a bit like I was saying earlier on about the matchmaking part, you know, we want to make sure you're with the right lender that suits you and suits them.
Absolutely, and this is what we always try to encourage, is be open with your power team, you know, your broker, your solicitors, your accountants. You really need to tell them everything, you know, and then they will suit whatever avenue is best for you and the business that you're looking to pursue. And again, I do see a lot of people that will kind of just not be open or forthcoming in how they're intending to use a property, hoping that it will get them a better rate or whatever, but effectively you are committing mortgage fraud, aren't you, if you're actually you know, operating the property as something that isn't allowed under your mortgage terms and conditions. So yeah, it's better to have the right product than
it's also, if something ever happens, Hayley, you know, say there's a fire or somebody dies, I mean, these things do happen, you know, you could end up in prison. You know, it is that serious, you know.
And your insurance wouldn't cover you.
You can't claim on the insurance if you've got the wrong tenant in there. So just, you know, just make sure you're thinking ahead, you know, and if you're in an area that you can only get those type of tenants, then
That's
build
what
that into your
you should be
strategy.
on. Yeah, exactly.
Yeah, and then we should get you the appropriate mortgage product, and just know what you're getting yourself into, because we can give you all these illustrations up front. Now, there's no charge to send you an illustration, and you can ask as many questions as you want before you buy the house. So, you know, please feel free to do that.
Yeah, fantastic. Great question. Great answer, David, as always. And so Daniel, you know Daniel, I think you've sorted some lending for him recently, which is fantastic. So Daniel's got a question. Hi, David. Can overseas investors benefit from the tracker rates that you were just talking about?
Interestingly, so Lender 4 does offer tracker rates, Dan, but you have to do it in a personal name. So the answer is yes, but you're going to have to maybe only look at buy-to-lets and not HMOs and multi-units. So if that works for you, then potentially yes, we can do tracker rates, but only as an individual investor and not as a limited company.
And it's worth just adding there that you may want to speak to your accountant as well and tax advisor, just to see what position owning a UK asset in your own personal name would have on you as an international investor in the UK, and how that may affect you when you come to bring the profit from that asset back, of course, to you wherever you're living. I actually don't know. Where do you live, Dan? Let me know. I've always assumed that it's local, as in Europe. So we'll see. It is.
I can say that. I think he won't mind me saying that.
No, I don't think he will. Brilliant. Okay. So Stephen said, oh dear. Yeah, good luck with that, Stephen. If you do need any help, give us a call offline, and of course we can have a conversation with you. But we don't have any more questions coming through. So some great questions there. Thank you very much for the update. I have a market update that I'm going to go through now, so you're more than welcome to stay on, or you can drop off. I'm actually going to scratch a whole page of my last because you've covered it all. So it will be a short market update. So I'm going to say thank you so much. It was a pleasure as always. If you are looking for lending for an asset that you're looking to buy, definitely speak to David. He is a fantastic, very approachable, very friendly, and will always go out of his way to make sure that he is matching you to the best product for the investment you're looking to buy. So he comes very highly recommended. So David, I'm going to say thank you. It was a pleasure as always. And we've got lots of thank yous coming through. I'm going to ask you to jump off camera and just mute yourself. You are welcome to leave. You won't cut air or anything like that. And I'm going to I'm going to jump on and do my market update. So thank you very much.
Thank you, everybody. Bye-bye.
Bye. Right, so I'm going to stop this presentation. This is where you see my my IT skills, which are pretty non-existent. And then I'm going to jump onto my market update. So as I said, David has actually covered quite a lot of what I was going to talk about. So I'll keep it brief. So probably about 5 or 10 minutes, short market update, and then we'll go through events with Your Freedom Empire, and then we'll call it a day. So thank you very much for your patience. I know that we are running slightly behind time, but hopefully I'll be able to pick it up now. So I'm going to jump off camera and start my market update. So I'm going to put questions on there as well. So where's this housing crash that everyone's been predicting? What do some of our data collection sites say? So I'm going to go through some different updates from various different publications for January, and we'll see where we are at the end of it. So Rightmove, so house price index says bigger than usual, new year, bounce back after extended year-end lull. So after 2 months of falls, average new sellers' asking prices rise again by 0.9% in January, the biggest increase at that time of the year since 2020, as new year sellers seem to be testing the marketplace. However, average asking prices are still £8,720 lower than their peak in October. That was October last year. It's early days, but there are some signs of positivity in the first month of the year. The number of prospective buyers contacting agents is up 4% compared to the same period in 2019, and up by 55% compared with the 2 weeks before Christmas, the biggest New Year bounce back since 2016, after the extended lull at the end of the year. However, the number of inquiries is down by a third compared to the buoyant market seen this time last year, which is understandable. It was a market frenzy. Would-be sellers jump into action with the 5th of January, the third busiest day ever for people asking agents to come out and value their homes, which is an early sign of confidence for the year ahead. Average monthly mortgage payments for hard-pressed first-time buyers continue to fall as mortgage rates or interest rates soften, with the deals now on offer of around the 5% mark, which David's just actually covered. But this is more for first-time buyers. So forecasting house prices is a delicate art, relying on an understanding of complexities of mortgage debt and mortgage debt markets. While rental values are equally difficult to predict, the key driver is at least a little simpler. It's the balance between demand and supply and intense demand pressures. At its peak in July, UK rental growth was running at 12.3%. Rents in London rose by 17.8%. This is more than just a post-pandemic recovery. Both rents in London and nationally had already returned to pre-lockdown levels in 21. Average UK rents were 14% above their pre-pandemic level by August 22, and London rates were at 9.8% above. Having recovered from the rent falls we saw during lockdown, surging demand and dwindling supply is driving rental value growth. There are 26% fewer homes available to rent in Q3 2022 than the pre-pandemic average, according to data from Rightmove. In London, the shortfalls was even greater at 30% at the same time. And the monthly RICS, so Royal Institute of Chartered Surveyors, survey shows that demand from prospective tenants nationally has increased in every month since May 2020. These measures suggest that today's high levels of rental value growth will persist across the country through the coming months. So reporting from the week says the number of households privately renting has more than doubled over the past 2 decades, according to the 2021 census. So to 5 million, average rents across the UK were up 10.8% annually in December 2022. The average Greater London rental properties was priced at more than 2,000 in December for for the second month on record. Even when you remove London from the equation, rents were still up by 9.4%, according to HomeLet. These increases mean a single tenant on average faces paying 35% of their income on rent, which is quoted to be the highest level of rental affordability in over a decade. I don't know about you, but I was quite surprised about that. I thought it would be higher than the 35%. I've always calculated tenants' affordability at 35% of their income. Perhaps let me know in the chat box what you would normally calculate it at. But I guess if you lump in higher prices for things like energy, household goods, it's not exactly a great time for generation rent. So why are rents rising? So Sky News says the rental market is currently stretched to breaking point, with a lack of stock restricting tenants' choice and tax hikes deterring landlords, as well as increased competition for places. A shortage of properties to rent both privately and in the social housing sector is pushing up prices in the private rental market, and properties are being snapped up before viewings and bidding wars are now appear to be, and I can confirm this just from my own portfolio and the fact that I own a lettings and estate agency, it is commonplace for bidding wars to be going on. I read an article yesterday, so this is kind of highlighting private landlords, but I read an article yesterday that Wolverhampton, one of the councils that I operate in, are also putting their rents up by 8% in April this year. So it's not only the private rental sector that are increasing their rental values. Individuals are also being hit by higher mortgage rates since last year's mini budget riled the financial markets. We've heard all about that. So some would-be first-time buyers who would or could no longer afford the property they wanted, who are keen now to wait for calmer conditions before proceeding. They may actually now decide to stay renting for longer, which pushes up rental demand even further and prices. That was a quote from The Guardian. But sharp rent rises are also being triggered by landlords passing on rising interest rates from their own buy-to-let loans and ever-increasing costs to comply and maintain their assets. In some cases, others are following their example, and I suspect this is for fear of rent price caps and rising taxes, no-fault evictions on the horizon, EPC performance upgrades. Sorry for the ambulance in the background there. The list is endless, basically, but I believe it's most of all because landlords have not been exercising their annual rent increases over the last 5 years. Many landlords that I speak to don't increase their rent on an annual basis, and this is why we're seeing such a huge spike in rental growth prices, rather than a steady year-on-year rise. So I do think that now many landlords that I speak to just feel like they have no other choice. They've held on for as long as they can, and they are having to put rents up as a result of all of these increased prices. Landlords have been criticised for this. Why? I'm not sure. We are not a charity at the end of the day. We are a business. The cost of living has hit everyone, including landlords. Their cost of business have risen just like everyone else's, as well as their own cost of living as well. So why shouldn't they put their rent up to cover increased costs and to protect themselves and their assets and their own families? It always seems to amaze me why landlords are expected to behave like a business, yet criticised when they're doing that very thing. Energy companies such as Shell have had the highest profits on record, yet they are still hiking rates. Meanwhile, landlords are getting criticised to cover their overheads and protect their income. It's shocking, really, isn't it? As I said last year and the year before, rents would increase due to fall in stock levels, and demand growing year on year doesn't obviously help. The government has it's alienated landlords, this government, in my opinion, and landlords have got tired of the constant backlash and victimisation. And as a result, they've said enough is enough, and they've left the market and invested in different asset classes. In some instances, I don't blame them. Some smaller landlords that perhaps have 1 or 2 properties and they own them in their own personal name and they're still working full time, it really is very hard at this moment in time to make those bog standard investments that once were 10 years ago a good solid investment, to make them stack up in these conditions. And with ever-changing legislation, increase in taxes, increase in interest rates, and just the constant backlash, I really don't blame them. They can, if they're operating in that smaller, lower end and not as a full-time business and running a larger portfolio, I really don't blame them for looking at different asset classes with much lower risk and equally as beneficial returns. So, as David said, the Bank of England raised their interest rates yesterday by 0.5%. Inflation has begun to fall, but is still well above the 2% target. Higher energy prices are one of the main reasons for high inflation, and higher prices for the goods we buy from abroad have also played a big role in this. Low and stable inflation is vital for a healthy economy, and so interest rates have risen to 4% this month. Since December 21, interest rates have gone from 0.1% to now 4%. By raising interest rates, the Bank of England can bring inflation down sooner and make sure that it stays low after that. They expect inflation to fall quickly this year. The price of energy is not expected to rise so rapidly either. The government has introduced a scheme that caps energy bills for households and businesses, and oil and gas prices have fallen a lot recently as well. With a £39 billion record revenue, I'm not sure, which I think was Shell that I read an article about yesterday, I'm not sure where the justification to increase the prices were, but instead of taxing, instead of a higher tax for energy giants, they're increasing government debt, which will in turn fall back to the taxpayer to repay at some point in the future. Anyway, moving on from that comment, I won't continue with that rant. I think it's clear on my opinion there. But the expectation of imported goods, that any rise in prices will be more stable and will not be expected to rise so fast, because some of the production difficulties that business have faced are starting to ease now. Higher interest rates will help to reduce the demand for goods and services in the economy, and this will, or should, help slow down the rate of inflation further. I personally expect there will be another couple of rises before interest rates stagger and then fall towards 2024. But of course, we all have our different opinions on that, and that's just mine. The positive is many lenders are returning back to the market and offering products around that 5% mark and above. And I think there will be, at some point in the near future, a price war for businesses in the mortgage world. Lenders will have to adopt and change their criteria in order to encourage business, and I'm thinking that they will start to be a little bit more flexible in the future as they can see things stabilising. But again, that's just my opinion. So hopefully, so short and sweet, just like me. Hopefully that was useful. If you do have any questions, pop them in the chat box. We've got lots of people saying thank you to David. I can see that he's stayed online as well. And I'm going to quickly just jump through our I should have wrote down the date, shouldn't I? I actually don't have this date, but if you scan the QR code on screen now, you will be able to sign up to our Property Success Convention. It's a free one-day event where we talk to you about all things property, structuring those assets, looking at supply, demand, research, how do you stack assets up, what numbers do you need to look at, how do you stress test, all of that type of stuff as standard, and of course the current market as it stands and strategies that will work for you right now. So that is a one-day event, and you can sign up to that by scanning the QR code online, or pop along to our website and sign up to the Property Success Convention. Of course, I'm on, I was going to say At Home with Hayley, but that's what we're on now. So I actually haven't been back into the studio this year yet. So I am due to go back. But Property TV have lots and lots of great guests. I've been purely just too busy to get into the studio. There's lots and lots of great content that they put out. It's on channel 186. You can watch all of the episodes that I've been part of on our YouTube channel or their YouTube channel, either or you can watch live on Sky 186. It's on a Tuesday and a Thursday between 8 and 9. And then again, just to finish off, if you would like to book a free consultation call in with one of our Your Freedom Empire mentors and team, it could be myself or anyone else, you can scan the QR code on the screen now or pop along to our website. Under the Education Hub menu, you can book in a free, no obligation, no upsell, purely a conversation, 30-minute consultation call with a mentor that is active within the field and currently investing and have been investing for a very long time. And that's it. It's February, it's Friday, and it's definitely a glass of wine for me tonight. I did dry January as well, so I'm really looking forward to a nice glass of either Merlot or Malbec this evening with my dinner, some family time, and basically recovering from January. So I'm going to say thank you so much to everyone. It's been great to have you on. Hopefully you enjoyed the session. Keep your questions coming in. You can pop any questions on YouTube as well. This will go onto our YouTube channel, so you can pick up and recap on anything that you may have missed or want to recap on. But I'm going to love you and leave you and say have a wonderful month, a fabulous February. Love is in the air. We have Valentine's Day coming as well, so at least we have flowers and chocolates this month, and it's a much shorter month than January, so always bigger smile on my face. But I'm going to love you and leave you. Have a wonderful day, and I'll see you all again next month. Goodbye for now.